Hi, I'm Marla Wynn with the Wynn team at Citywide Home Loans, and this is Your Way Home. Today's topic is pre-qualification versus pre-approval. I'd like to introduce my husband and business partner, Scott Wynn, who has more than 15 years in helping thousands of customers finance their homes.
You might be wondering what the difference between pre-qualification and pre-approval is. Too often, people use these terms interchangeably, and they're not the same thing. Unfortunately, also, a lot of people use the term pre-approved when a full pre-approval has not been put in place. So let me give you what I believe are the real definitions of these terms. Starting with pre-qualification. So pre-qualification is the mortgage lender's best guess at your ability to qualify. So in order to make that guess, they need to get some initial information from you. So generally that's going to include your employment history, your type of income, the amount of the income, how much money you have, and what your credit score looks like. In some cases these things are verified, but in many cases they are not. A lot of times at the time of pre-qualification, a credit report is pulled so the lender has at least that information to be able to assess your qualifications. But that's generally it, a credit check and a conversation. And based on that, the lender is then looking at and utilizing their experience to assess whether or not they believe you can qualify. Again, it's the best guess as to whether or not you're going to qualify for a mortgage. Now compare that to a pre-approval. The pre-approval is going to be basically taking that information obtained at the pre-qualification and proving it all. So if you said you've worked somewhere for the last year, well, let's get a W-2 to prove that that's the case. Let's get a paycheck stub to prove the amount of income you have. Let's get bank statements to prove how much money is sitting in those accounts. So the pre-approval step is just the pre-qualification documented, proved that you do indeed have what it is you said. Now, it's not that lenders don't trust you or that the lenders are assuming that everybody is lying. It's really just to make sure that we are doing things by the rules set within the mortgage business. For example, we have to obtain tax returns because within the tax returns there's a lot of information related to how the income is being reported to the IRS and how we'll be able to utilize it for mortgage qualifying. One of those examples is if you have unreimbursed business expenses as a commissioned type employee. So if you are a commission-based employee and you have some expenses associated with generating your income, whether it's tools or uniforms or marketing expenses, whatever it might be, and you report those on your taxes, those are unreimbursed expenses that deduct the amount of taxes you have to pay on your commission income. Well, from a mortgage qualifying perspective, we also have to deduct that out of your income. So again, that's just one rule, one example of where you may not be aware that it's going to impact qualifying, but indeed it does. So my suggestion is that rather than stopping at the pre-qualification stage or getting what somebody might call a pre-approval, if you have not provided documentation, I can tell you you are not fully pre-approved. I would encourage you to step through the full pre-approval process prior to going out shopping for a home and submitting offers so that you get a jump start on the underwriting process and know with confidence before putting down earnest money and spending money on inspections and appraisals that you can qualify for a mortgage and that home purchase.